Let me ask you a simple question. What if I told you that one single chart has quietly predicted every major equity bubble peak of the last 50 years? And almost no one is paying attention to it. How is that possible? Not the S&P 500, not the NASDAQ, not Bitcoin, not AI stocks. I am talking about the silver relative to the S&P 500. Basically looking at the silver relative to the S&P 500. Because this ratio does not lie. It does not care about narratives. It does not care about central bank press conference. And it does not care about Wall Street optimism. It measures real money versus financial claims. I am indeed spitting the facts. And today, this ratio is flashing a warning that most investors have never experienced in their lifetime. Take a look at it. Stay with me, because by the end of this video, you will understand why the next major market regime, the market regime shift, may already be underway. So what is this chart actually measures? This chart is simple in a way. What it does, it basically divides silver. Silver is divided by the S&P 500 index. That's it, right? But conceptually, it is one of the most powerful ratios in macro investing because it answers one fundamental question. And that question is as follows. Are real assets outperforming financial assets? Real assets like gold and silver, or are financial assets dominating reality? When the ratio falls, you could see stocks outperform silver. Financial leverage expands, liquidity is abundant, and risk is rewarded. But when the ratio rises, silver outperforms stocks. Liquidity tightens, inflation, crisis, or distress emerges. Capital seek tangible stores of value. And this is what's happening right now. People are scared. They're saying, what do we really have besides a bunch of paper money? We need something tangible, something we can hold. So this is not about trading silver, right? This is about a regime shifts. The long-term pattern no one discusses. Look at the structure of this chart across decades. One in the late 90s to early 2000. And another one from around 2011 through the early 2020s. What do you see? There are multi-decade compression phases. So basically, the periods that we're talking about had stocks compound relentlessly, silver is ignored, real assets are mocked. Were you holding silver and gold? Doesn't make any money for you. Speculation replaces discipline. And every single time this compression breaks, it breaks violently. The move is not gradual. It is not polite. It is not forecast by consensus economists. It is explosive. So let's take a look at the dot-com era lesson. Right? Let's go back. Late 1990s. Technology stocks were the future. Valuation didn't matter. Probability didn't matter. Cash flow didn't matter. Sound familiar? During that period, the silver to S&P ratio collapsed. Equities massively outperformed. Precious metals were declared barbarous relics. Then something happened. The ratio reversed. And that followed was a brutal equity drawdown, a lost decades for stocks, and a secular bull market in hard assets. Silver didn't need hype. It didn't need innovation. It simply needed reversion. Look at the chart, right? You see how it goes in the 2000, and as we approach 2008, 2009, right? 2010, there was a huge accumulation of wealth and also a huge preponderance for, we shall see. 2008 wasn't a pretty period, as some of you might remember, right? So what are we saying? Well, essentially that what we're looking at is a period of time when we are in need of actual hard assets. And if you take a look at it, it gets a bit of a problem. What are we talking about? This asset, this chart that you're seeing, does a lot of things for you. And let me explain to you very precisely what it is that I'm talking about. So basically, when the ratio falls, stocks outperform silver, and when the ratio rises, silver outperforms stocks. That's what it says. And you could see the target is moving up, and it's nowhere near where we've been in the past. Okay, so there's more to go here. Either silver goes up a lot, or the stock market goes down a lot. But you could see the little bit one on the right. It's starting to prick up. So what is a long-term pattern that no one is discussing? Well, look at the structure. And essentially, we looked at between the period that when it breaks violently. So let's take a look at the dot-com era. Late 1990s, technology stocks were the future. Like I said, nobody cared about cash flow, nobody cared about valuation, nobody. And then the ratio reversed, and it was brutal. As you remember, when the dot-com thing exploded, it was really bad. Okay. Now we have the 2008-2011 explosion. What happened there? Well, now look at the spike. You see that spike? That's a 2008 to 2011. That was not random. That was not coincidence. This was a financial system stress. Central bank balance sheet expansion, currency debasement fears, loss of confidence in paper claims. Silver didn't just outperform stocks, it obliterated them on a relative basis. Doesn't mean that the stock market went up, but it means that the ratio, the silver to S&P went up a lot. And notice something critical. That move didn't happen at the peak of panic. It happens after years of compression. That's how regime changes work. Then, of course, you have the post-2011 area when we start to drop. So the ratio collapses again as it goes down. Why? Because we entered the most aggressive financialization experiment in history. Zero rates. Remember when we had the 2008 financial crisis? The Fed usually says, you know what, zero rates. Right? Bring down to zero. QE, infinity, stock buybacks, passive investing. Just sit there and collect the money. Index concentration. After 2008, it didn't do much of anything because rates were so low, the market kept going up. Narrative-driven markets. Everything flowed into equities. Why? Because rates were low. You didn't earn anything, 0%. Where are you going to put your money? You have to put your money in the stock market. So silver was starved of capital. Commodities were dismissed. Hard assets were ignored. And once again, the ratio formed a deep, long base. Longer than the one from the 1990s, more compressed, more extreme. So why this base matters more than ever? Well, this time it's not like the past. This time we have record government debt, structural deficit, deglobalization, supply chain fragility, energy transition metal demand, monetary credibility risk. Right? Nobody believes in the dollar. So silver is not just a monetary metal. It is an industrial metal embedded in solar panels, electrification, defense system, AI hardware, medical technology. Meanwhile, equities are priced for permanently low rates. We're waiting for the low rates. That's why the government was pushing the Fed to lower those damn rates. Permanently high margins. Permanently stable geopolitics. We don't have any of this anymore. These assumptions are fragile. And this ratio knows it. So look at the far right of the charts where we are now. Do you see that? Do you see that uptick? That's not noise. That ratio is trying to turn. Historically, these turns start quietly, and they are dismissed, ridiculed, then they accelerate violently, as you could see. By the time CNBC talks about silver, the move is already halfway done. So, this is not about silver alone. Let me be clear. This is not a call to sell everything and buy silver. No, this is a warning about relative valuation extremes. It's a warning about financial assets priced to perfection, real asset priced for irrelevance, and a system dependent on continuous liquidity. How long is the Fed going to continue what it's doing? When confidence cracks, capital doesn't go where it's loved. It goes where it is undervalued and real, therefore gold and silver. The silver to S&P ratio is not a timing tool. It's a truth factor. And right now it's telling you the era of effortless equity dominance may be ending. The next decade will not like the last one. Diversification will matter again. Real asset will matter again. Discipline will matter again. Ignore this chart at your own risk, because markets don't ring bells. They whisper right before they scream. So pay close attention. Pay close attention, because I think we might be in trouble. So let me show you another chart. Okay, so let's take a look at this chart. This is what happened yesterday. That one. Look at this. Look at it. Look at this chart. No noise, no opinions, just raw price action. Silver went from 83.75, an all-time intraday high, to 75.15 in just over 1 hour. That is a 10% collapse on what was supposed to be a breakout, right? This was not profit-taking. This is not a healthy consolidation. This was a forced liquidation. And if you understand what this chart is actually being telling you, then you understand something far more important than silver. You understand what is happening beneath the surface of global markets right now. This was not a random trading day. This was a positioning event. Silver has been building momentum for weeks. Open interest was expanding, leverage was piling in, and then at 6:20 Eastern, silver exploded higher straight into a vertical spike. That move sucked in late longs, breakout traders, momentum funds, retail ETFs, and right there at the top, the trap was set. 83.75. A new record high. A textbook breakout level. If you zoom out historically, this was a psychological and technical magnet. And market loves market because market concentrate leverage. But there's a critical insight. Real bull markets do not reverse this violently at the highs. This was not distribution over days. This was an instantaneous rejection. This tells you something crucial. You see the price of silver? That there was not enough real physical demand to support the paper leverage. Now look at the volume. Look at the volume. As price begin to roll over, volume doesn't fade. You see the bars at the bottom? This was not discretionary selling. This is a margin liquidation. Stops get hit. Forced selling accelerate. ETF rebalance. Market makers pull bids. And once the cascade starts, price doesn't fall step by step. It air pockets. Boom, 83, 80, 78, 76. No bids, only exits. So at 19:30 Eastern Time, at 7:30 p.m., silver prints at 75.15. Let's be precise. That is an $8.6 move down in roughly 70 minutes. That magnitude is not normal, even for commodities. That was leverage being erased in real time. And notice something important. Price stabilizes, but does not bounce. That tells you sellers were not finished. They were simply temporarily exhausted. This chart is not about silver. It's about a system fragility. Silver is one of the most leveraged, paper-dominated markets in the world. When silver breaks like this, it's exposing excess leverage, synthetic supply, weak hands, thin liquidity. The same dynamics now exist in equity index futures, high-yield credit, tech momentum stocks, and crypto derivatives. Silver just rang the bell. Markets don't punish people randomly. They punish crowds. This was a classic bull trap. Price breaks out, confidence spikes, leverage increases, liquidity vanishes, and forced selling begins. By the time traders realized this was happening, they were already trapped, and the faster the ride, the more violent the fall. There was only three. What happens next, right? So there are only three paths forwards, based on my understanding. Number one, dead cat consolidation. You know, the dead cat bounce, like something is moving, you see, oh, the market is picking up. No, the cat is dead already. It's just a dead cat bounce. Silver chops away sideways while leverage clears. This takes time. Confidence erodes slowly. Scenario number two, secondary breakdown. Price revisits $72 to $70 as residual leverage unwinds. This is common after vertical moves. Scenario number three, structural reset. Paper positioning collapses. Then physical demand reemerges at much lower prices. What is not likely? An immediate return to $84. Markets do not forgive leverage overnight. So why is this a warning? Well, this move happened without a recession, without a credit event, without a systemic headline. This is key danger. If this is how silver trades in calm condition, what happens when volatility returns? This is why these events matter. They reveal the true depth of liquidity. And today, liquidity is paper thin. So this chart is not bearish. It is revealing who was over leveraged, revealing where liquidity disappears, revealing how fast confidence can slip. Silver did not fail, leverage failed. And when leverage fails here, it eventually fails everywhere. If you understand this move, you are ahead of the curve. If you ignore it, the market will eventually force you to learn it the hard way. Dude looks like someone who's completely sure that he saw an alien. He has been working the last 15 to prove he's right. Dude looks is in danger to children. Goodbye. Well, everything else. You're trying to bring the information. Everybody's really receptive to everything that I'm saying, but that's okay. Don't forget to join this channel and to subscribe if you want to really understand what's going on in the market and make some money with gold and silver and options. And join my Patreon channel to support this channel, or subscribe about some thumbs up to make up for this person that obviously does not understand what is truly happening in the world. platinum, anything that has to do with a hard asset right now is going to be a problem. I mean, the more I look at this, the more I'm studying, the more I'm trying to understand what's going on. I think what's happening now, of course, we could be wrong, and you probably want to be wrong, but I think the hard assets are the way to be, because financial assets are just going to disappear. So I'm going to do something on copper, and I was looking at platinum as well. But right now it's pretty tough, because it looks like we have a systemic risk. People are not trading these commodities, to trade them. They're using to protect themselves, just in case paper assets go away. I'm specifically the dollar. And why? Because there's way too much debt. That topic hasn't come up yet, but it will. And when that thing comes up, that's going to be a big problem. Because keep in mind that at $37 trillion, that level is manageable currently, but it is not sustainable. So we shall see. Let's take a look at this one. This one could be a doozy. This one could be very interesting, I have to say. Because basically what we're going to do is we're going to compare what we're looking at all-time low asset relative to financial assets. And you could see that every time they spike and they spike, we've been going down forever here. Yes, all our assets right now are indeed overvalued. I mean, undervalued. That's definitely it. So let's take a look at this chart and explain to you what I think is going on. So this is a chart that basically, bring it out so I could see myself. But easier to take a look at it, as you see. Okay, here we go. So let me ask you a question. What if the biggest mispricing in global markets today, not stocks, not bond, not crypto, but real assets themselves? What if commodities, real estate, tangible assets are sitting on the cheapest valuation relative to financial assets in more than 100 years? Maybe that's what we're seeing right now. This is not hyperbole. This is not an opinion. This is what this chart shows. This chart goes back to 1925. Look at it. A full century of market history. And today, right now, real assets, I'm talking about silver and platinum and lithium or whatever, relative to financial assets are at an all-time lows. Lower than the Great Depression, lower than World War II, lower than the end of Bretton Woods, lower than the dot-com bubble, and lower than the global financial crisis. This is not normal. And when something like this happens and appears in a 100-year data set, it is not a curiosity, it is a warning. Let's be very clear as to what we're looking at here. This is not a chart of prices. This is a chart of relative prices. It compares, because more and more you're seeing in the market prices go up and down. No. You have to start looking at the market differently. And this is what this channel is about. This channel is about looking at relatively, trying to figure out where the next risk is going to come from. So on one side, you have commodities, real estate, collectibles, hard tangible asset. On the other side, you have large cap stocks and long-term bonds. This line tells you how much real assets are worth compared to financial claims. Well, we're doing the ratio. Real assets versus financial claims. Paper money versus, real stuff. And historically, this ratio oscillates. It never stays extreme forever, except today. Today, the ratio is telling you that financial assets have been massively inflated relative to the real economy, and that has consequences. So let's go back to the 1920s. This chart shows, and it starts high. Financial assets were cheap, real assets expensive. Then came excess leverage in the 20s, right? Credit expansion, financial speculations, asset bubbles. Sound familiar? Then came the Great Depression. What happened? Financial assets collapsed. Stocks imploded. Debt was destroyed. Real assets, they survive. This is your first lesson, right? Paper claims are fragile. Real assets endure. And that's what the problem that I'm seeing right now is, this love for silver and gold and all that, including JP Morgan has been buying lots of silver. Why are they holding so much hard assets? Because they are concerned that the soft asset, the financial assets are not worth anything. They're only worth what it's printed on. Now look at the 1940s, World War II. Total economic mobilization, supply destruction, currency debasement. Real assets surged relative to financial assets in the World War II. Why? Because government print claims, but they cannot print oil, they cannot print copper, they cannot print land or food. Then came Bretton Woods. Look at this Bretton Woods situation where basically they said the U.S. is king now. They could do whatever they want. A gold-anchored system, capital controls, financial repression. The ratio stabilizes. Why? Because money was tethered to something real. Basically, what they said was that the dollar in 1940s, they say, okay, we're gonna use a dollar everywhere. People say, whoa, hold a second, it's just a piece of paper. You mean you print a piece of paper saying you're $1 and I gotta give you goods for it? Is it that strong? I say, okay, fine. Then we're gonna back up the dollar with gold. That's what happened. So money was tethered to something real. So now pay attention. This is critical. Look at the 70s. Bretton Woods ends because basically Nixon said, you know what? We're going to depeg the gold from the dollar. Inflation explodes because now you could print as much as you want. Oil shocks hit. And what happens? Real assets massively outperform financial assets. We might be in this case right now because in terms of inflation, we are copying a bit too closely what happened in the 1970 with the real inflation. Take a look at it. This chart spikes. Stocks fail. Bonds fails. Cash fails. Real assets protect purchasing power. This was the last inflationary regime shift. And today we are repeating the monetary condition that caused it. And with far more debt. I mean, the 70s, yeah, we had inflation, some of you might remember, and people lost their job, there were a recession, but then we didn't have that much debt, but he had $37 trillion. Now watch what happens in the 80s. Volcker crushes inflation, he comes in and you say, you know what, enough inflation, we're going to raise interest to like 10, 12%. Interest rates fall for 40 years. Financial engineering explodes. Derivatives multiply. I know, I was there. I was one of these guys. Buybacks replace capex. Financial assets soar. Real assets, who needs a bold, ignored, underinvested, depleted. You see what's happening? This is the area of paper wealth. And it culminates here. Look at the label, Fall of the Burning Wall. NAFTA, China joins the WTO. Globalization suppresses inflation. Cheap labor, cheap goods, right? Let's build the stuff overseas. Asset inflation without wage inflation. This is fantastic. Thank you. Thank you, China, for joining the World Trade Organization because now you make the stuff much cheaper overseas. And of course, companies that exported their business overseas, financial assets explodes higher because you make a tremendous amount of money. You pay your workers nothing. But the world is ending. That particular world is ending. That's what's happening right now. Deglobalization has begun. I mean, what do you think the US is doing right now? They're saying, listen, no. We're not going to build everything overseas. We're going to start building the stuff over here. I don't want to have to depend on my semiconductor on China. I don't want to depend on my medication in China or India. Energy security matters again. Resources matter again. Come on, listen to what happened with the rare earth situation. And yet, real assets are cheaper than ever relative to stocks and bonds. That is a contradiction. Now, we reached the final segment, COVID. Trillions printed. I mean, they went to town on that one. They say, you know what? Whatever you want, you could have. Stay home, we'll pay you. Deficits normalized. Debt mathematically unpayable. It is manageable, but it is not sustainable. That's what the Fed chair said. Central banks are trapped, and yet the ratio keeps falling. Why? Because markets still believe in financial asset performance. A strategy for 2026 is be careful. This channel is about the black swan. So what we do is we look at where the risks are coming from. What is going on? What is the concern? I don't want any problems right now. I'm going to be looking forward, and what I want in terms of an investment strategy for 2026, I want to know where the risk going to come from. This channel is not about, buy this stock and buy this other stock. I don't know what the stock market is going. I mean, I can't tell you which stock to buy and not to buy. This doesn't make any sense because no one is able to predict this thing anyway. Okay. But, and no one is focusing on that, is you need to focus on the risk. It's like me asking you to cross a street. Your goal is not to cross a street. Your goal is not to get run over before you get to cross a street. But right now, everybody's focusing on, let's cross the street. So you should be worried about 2026 because of the fact that people are buying gold, people are buying silver, people are buying platinum, people are buying copper. Why? You don't need that much gold. Because the concern is that the financial assets are losing ground. The concern is we might have a war somewhere. Everybody is one way or the other, the left or the right. There's nothing in the middle anymore. So you have to be very careful. So we're looking for signs, I mean, the ratio keeps falling, right? The ratio of paper assets to real assets. Why? Because markets still believe in financial asset performance. They still believe in financial permanence. They believe governments can always paper over reality. History stays otherwise. History says, be careful. Every time this ratio has reached an extreme, one of the two things happen. Either financial assets collapsed or real assets massively reprice upward. Sometimes both. What never happens? They never stay here. Markets always mean avert. Always. So this chart is not bullish, it is not bearish, it's diagnostics, right? It tells you capital has been misallocated, scarcity has been ignored, and reality has been deferred. And eventually, reality always arrives. When it does, the winners will not be the most leveraged. They will not be the most financialized. They will be the ones holding things that cannot be printed. Silver, gold. This chart has only flashed this signal a handful of times in 100 years. And every time it mattered. And that's what's happening right now. Of course, everybody says, well, let's buy silver because it's going up. So you're buying silver, therefore you're pushing it higher. Yeah, you are doing that. But the people that are in the know are buying silver because they know that something is coming to roost at some point. A war, the fact that you can't keep printing money, the dollar is losing ground. The U.S. is trying to revert that to make the dollar relevant again, but maybe it's doing it in too much of a forceful way. At some point, China is going to say, what? I don't need you. I don't need you. I could make my own solar panels. I could make my own semiconductors. I got a great biotech firm. I could make my own medicine because I've learned from you, so I do not need you. Go away. And what is the U.S. going to do? Look what's happening with the rare earth mineral. I want China, please give me some. I don't know. Let me think about it. Make your own. No, it's going to take me 10 years to make rare earth mineral. And if I don't have rare earth mineral, I cannot build missiles to protect myself. You know what I mean? It's a big picture. And it's happening right now. So what we do in the channel, and more precisely, obviously, because someone needs to support this channel, in my Patreon channel, what we do is we become very granular and say, okay, so what are we going to do? Shall I maybe hedge the S&P 500 to make sure that in case something happens, besides buying silver and gold, maybe I could make some money when the market collapses by 10%? Because everybody wants to make money. Nobody wants to lose any. Therefore, you should be focused on trying not to lose any money rather than trying to make money.